In this lecture, I am going to talk about money in general, and that's going to lead us into talking about the monetary system and the central bank. So this is chapter 16. In these, again, these always show the combined text, like micro and macro together. So in this case, it's chapter 29, but this is really chapter 16. Okay. There's this commercial you used to see as a kid, and it started out like with a kid saying, like, why do we need money? And the parent says something about, like, because that's how we buy goods or something like that. It turns out that's a pretty good basic understanding. What I would add to it is that money is whatever we want it to be. Money captures value. Something becomes money because others will accept it. Because if we didn't have money, the alternative is that we would trade goods for other goods, and that would be your barter situation. Now, the problem with a barter is this double coincidence of wants, meaning you all paid money to the university to take this class. Because if you hadn't, then, I've got talents, right? I got things I can do, but one of the more marketable things that I can do here is that, I know economics. And now the problem would become, what can I ask of you in return for delivering an economics lecture? It's kind of like when you go to when you see these like TV shows or movies of like olden times, and like there's like the country doctor in like the farming town, and like he's got like lots of eggs and lots of bacon and lots of food, but he's really, really poor. He has no money. And that's because, right, the farmer needs medical care, and they get the medical care, and in return, they give him like 3 dozen eggs or whatever. And that works fine because the farmer's got to, or the doctor's got to eat. But the problem very quickly is going to become one of like, what could I possibly need from you that would be of value to me enough to give you an economics lecture, right? I mean, there's not much, unless one of you says, like, I'll drive you around, Shiting, wherever you want to go, or hey, Shiting, I'm really good at artwork and I'll make all the art paintings for your house, or hey, Shiting, I'll watch your kids for you. After those few things, dude, I don't know really what you could give me that would be of value. And it would take a while to figure out what each of us wants. Isn't it a lot easier just to say that this class is going to cost, right? This class costs about what, $4,500 or so, $5,000. You pay the money to the university pays me. Pretty simple transaction. So one of the things then that money does is it makes trade easier. Okay, so with that said, let's keep going here. Money then becomes basically the assets that are in the economy that are regularly used to buy goods and services. Something loses status as money to the extent that it doesn't fulfill those conditions. So things like a Bitcoin. It's difficult for me to conceive of a Bitcoin as money, only because I don't actually see people tending to buy things with it, right? At least like non-creepy, weird things, right? Um, right, like the bigger uses of Bitcoin is you're probably up to no good if you're using Bitcoin for your purchases, right? You're either buying a prescription drug without a prescription, um, you're buying um, uh, you're buying things that um, you probably shouldn't, right? Um, you know, illegal fireworks. You're buying, I don't know, like use your imagination. Um, and the value of Bitcoin is that it's completely anonymous. It's just clunky to use. I don't live an exciting life. I don't buy any of that junk. So as a result, I have no desire to buy Bitcoin. And none of the merchants I deal with would want to take Bitcoin because there's no need to. We don't mind in our transactions that what do I care if the government knows I bought 50 pounds of rice? Big deal. Um, and yes, there are illegal transactions out there. It's about 5 to 10% of the US economy is illegal transactions. Is that enough to sustain a currency? Probably not. Something else that money needs to do is it needs to provide some degree of liquidity. Basically, how fast can it be used? US dollars are actually quite liquid, right? Because I can take them to almost any merchant and use them. Same with a checking account, right? I can either write a check or use my debit card and have pretty easy access to um, that money. Lack things that I could own that don't have liquidity would be like my car, right? My car, I'd have to find a buyer for it and then actually sell it. My house also does not have liquidity, right? Because it would take a while to sell it and actualize the value inside of it. But to actualize the value of a dollar doesn't take very much because it's basically a dollar right away. Um, money serves the following three purposes. It is a medium of exchange, it is a unit of account, and it is a store of value. As a medium of exchange, we saw this with, as opposed to a barter, in money when it serves as a medium of exchange, it's what buyers can give sellers and it's what sellers want from buyers. So it's that nice intermediary between the buyers and the sellers that both of them either are willing to give it or accept it. It's also money is something that must serve as a unit of account, meaning that my salary is listed in dollars. My debts are listed in dollars. My assets are listed in dollars. And it also stores value over time. By that we mean if I found a quarter under my car seat that was from 2004, that quarter still has value. Now, it might not buy the same amount of stuff that it could have bought in 2004 because inflation reduces that value, but there's not that much inflation in the US, and so it wouldn't have lost that much value. But that last point becomes important because if you have a currency where there is exceedingly high inflation, then that money starts to not be used anymore because it's not retaining its value over time. Now, when you think of money, one of the natural ways to think about it would be that the thing has some value, some intrinsic value. So like if we say something like the gold standard, um, when we say that something has the gold standard, of which there is, by the way, no currency in the world that uses the gold standard. The gold standard would say that you can take whatever the currency is and convert it into gold. The reason why no country in the world uses this is because then you can only print as much currency as you have gold, which becomes then a limiting factor if bad things are happening in your economy. So most countries in the world during the 20th century, during the 1900s, abandoned the gold standard. The US abandoned the gold standard in 1933, if I'm not mistaken, 1933 or 1934. Right now, our currency, as we'll see here, well, let me just jump to this and then I'll go back to it. Our US currency is a fiat currency. It's a fiat money. It has no value. The only thing that makes it of value is this line that's on the dollar bill, that this note is legal tender for all debts public and private. Let's just look at something here just to highlight here this difference. So this is a good one to look at here. So this is what the US currency used to look like. Now, what you can see is that it's got slightly different colors going on here, but what you see at the bottom here bears mentioning. $10 in gold coin, payable to the bearer on demand, meaning it's worth $10 in gold if you give it up to someone else. So this is a classic gold standard type of currency. As opposed to, well, even up until the very end of the gold standard, you can see in this currency here, which is used in 1928, you'll see in the upper left-hand corner where it says redeemable in gold on demand at the US Treasury, or in gold or lawful money at any Federal Reserve Bank. You could turn in currency for gold. Let's go back here. Kind of bothered me. Was it 33 or 34? Are you, what day was it? Are you fucking kidding me? That's fantastic. It was on my birthday, June the 5th. On my birthday, which is also, by the way, the birthday of Adam Smith, the very well-known economist in 1776 who wrote Wealth of Nations, but it's also the birthday of John Maynard Keynes, Keynesian economics, two great economists, and it's the date in 1933 that the US goes off the gold standard. And Scheiding's born. I mean, I don't know. Maybe I was born to be an economist then, because that is pretty fantastic. June the 5th, 33. Let's go back. Sorry. That was totally just surprising. As opposed to Just want a good vision here of a currency. This is poor. Looking at these images, not this class. Although you may think that about this class. Let's just go to the Wikipedia entry. And I'll do the job. You'll notice here on this $2 bill that there's nothing on it that designates anything about gold or anything like that. The only thing is in the upper left-hand corner where it says this note is legal tender for all debts, public and private. Basically, the value of this fiat currency comes from the fact that it can be used for all debts, public and private. Now, there are other things that can have that can be money as well. So there's the gold standard. There was a silver standard that was debated between gold standard and silver standard in the United States in the late 1800s, late 19th century. There's a famous and very short article that was written after World War II where cigarettes were used in POW camps. The one that I always find interesting is that in prison, the two things that are considered money are stamps, which makes sense. So you can't hold money, but you can own stamps. So that would make sense. I don't know how much a stamp costs these days, but stamps would be a pretty good way to hold value. But that the other thing that holds value, which is incredibly valuable, would be if you have a contraband cell phone, it would be like, like a refill card for your cell phone, like the minutes and whatnot. But those are the two kind of forms of money in a prison. Now, what is it in the economy where we see this money circulating around? Well, the obvious one is currency. Currency which consists of bills and coins. Coins that are minted by the US Mint, paper bills which are printed by the Bureau of Engraving and Printing. So the US government is making the cash, physically making the cash, but that money is also outside of physical notes and coins. It's also in the demand deposits. Demand deposits are basically checking accounts. So checking accounts are money as well, because it can be used to buy almost all the same things that actual dollars and coins can buy. Which then leads us to then measuring M1 and M2. These are different ways of defining the amount of money we have out there. So M1 most narrow, most liquid. And that's basically currency, demand deposits, which are checking accounts, and traveler's checks. I don't even know why they still talk about traveler's checks. I think it's an antiquated notion. I'm sure some of you don't even know what one of these are. I remember going on the state once in graduate school with this person that went to a Blockbuster Video, which I guess is already dating me, but we went to a Blockbuster Video to watch Donnie Darko, a great movie. And I think I was buying the food. She was paying for the movie rental, and she busted out a traveler's check. I mean, who does that? Who busts out a traveler's check? Let's look at what one of these looks like. So basically, the idea behind the traveler's check is that you can use it, and if you lose it, it can be replaced. But it's basically as good as cash. And sure enough, the Blockbuster Video did accept it. Um, it just basically looks like a check, basically. This one's a Canadian one apparently. Um, but it looks like actual money, except they can be replaced. I'm talking about so much about my life this lecture. M2. So it's everything in M1 plus some less liquid items. So that'd be things like a savings account. So a savings account, technically speaking, there's a holding period on your savings, what's in your savings account. Most banks, I suspect for most of us in this class, we don't have like millions of dollars in a savings account, right? I think I have $5 in my savings account. I don't think Navy Federal Credit Union is going to care if I take the $5 out. I think they'll be okay with it. But if I had $1 million in my savings account, Navy Federal wouldn't let me just take it out because the savings account is supposed to pay more interest, and therefore it's less, and it pays more interest because it is less liquid. Then you've got small time deposits. Another name for a time deposit is a CD, a certificate of deposit. And then also you've got some money market mutual funds. These are things that are um, like dollars, but they're invested in the stock market, not in the stock market, in the fixed income market, like US government bonds and corporate bonds. We don't need to look at this way. Let's update these numbers. Okay, so the money stock is right now is $18 trillion. Look at what happened since the pandemic started. I am surprised always when I look at this data and people tell me they do not expect inflation. How could you not expect inflation from a money stock that has increased by almost a factor of 5? I don't know how you couldn't. Um, there has to be inflation because there's just so much more money out there. Okay, so here's our M1, 18,139. Look at that. Let's see. M2 is 19,394. You could then subtract these two to get the value of M2, which is saying quite a bit. By that I mean, it used to be the case that of the total M2, about a fourth of it was M1 and the rest was M2. Now, the bulk of it is all in the M1, 18,139. to 19,394. That's just a lot of money being put out there. And I don't really know what else you can say about it. Okay. You don't need to worry about this. Now, once we know what money is, now the question becomes, how do we manage how much money is out there? The management of the money supply, the determiners of how much money is out there, is done by the Federal Reserve. So by this we mean the government can't just go and print cash to pay its bills or to pay for legislation. The Federal Reserve creates and destroys money. It manages the money supply. It's one of the key things that it does. And it does this then to either stimulate the economy like it needs to do during the pandemic, or cool the economy down, which is what it should have done during like the housing market or during the internet stock bubble. There should have been more done to reduce the money supply. And some would argue perhaps right now something should be done to reduce the money supply. So what is the Federal Reserve? The Federal Reserve is the central bank in the US. It's again the job of controlling the money supply. It was created in 1913 after a pretty bad recession in 1907. It was so bad that the economy nearly collapsed until it was bailed out by a really rich person, Piers Morgan. And Theodore Roosevelt, who was president at the time, was so upset that we had to be bailed out by a very rich person that he created the central bank, the Federal Reserve. Now, there had been other central banks in the United States. There was like a first central bank, Bank of the US, back when the country was founded, which I think was made by like Alexander Hamilton. Then you've got the second Bank of the US, which was like in the 1820s, 1830s. And then you didn't get anything until the Federal Reserve. But with the Civil War, there were attempts to try to get a central bank back into doing things. Not only does the Federal Reserve or the Fed control the money supply, as indicated right here, but that the Federal Reserve also regulates the banks. Now, the Federal Reserve is organized with kind of a base of operations as the Board of Governors. So the Board of Governors is the boss. The Board of Governors has 7 members who serve 14-year terms. They're appointed by the president, confirmed by the Senate. The chair of the Federal Reserve, the chair of the Board of Governors of the Federal Reserve, is usually the name that some people know. Like Alan Greenspan would have been in that role. Ben Bernanke would have been in that role. Janet Yellen would have been in that role. And now Jerome Powell, Jerry Powell. And what the chair of the Board of Governors of the Federal Reserve does is they preside over the board meetings and they testify and they basically direct everything. They direct the staff to do certain things. They are the most powerful person on the Board of Governors, and the chair of the Board of Governors serves a 4-year term, and they're appointed by the president. Then, if the Board of Governors is like the central agency, then when you were creating when the Federal Reserve was created in 1913, there was concern still about federal versus state rights. And there was this concern that all the power would be in Washington, D.C., where the Board of Governors is located, and who would represent Montana and Texas and whatnot. So the idea was made that what they would do is they divided the country up into 12 regions. And that these 12 regions were around the um, major cities in the United States. And each of these districts have a president that's chosen by the board of directors. And each district has shares of ownership that are purchased by the banks in that district. Let's look at what the map looks like. Actually, I think why would they not put a map in this? It's kind of odd. It's unusual. Let's look at the original. So this is the original. In the original, we didn't have Alaska or Hawaii. So imagine Alaska and Hawaii. They're all part of District 12, which is based out of San Francisco. Then you see that there are other, so Kansas City is the 10th district. And then there's other dots here, Cheyenne, Denver, and Omaha and Oklahoma City. What's happening in those cities back in the day is that checks would be processed in those kind of regional cities. So for San Francisco, we still have Phoenix, we still have LA, we still have Portland and Boise. I don't think we have Salt Lake. I don't think we have Reno anymore, and I don't think we have Portland anymore. But also now less checks are written. So now these like branch offices don't serve as much of a role. I used to be with District 7, the Chicago Federal Reserve District. And there was Detroit, there was Indianapolis, there was also a Peoria office, Des Moines, and Milwaukee. And again, each of those branches, Detroit, Milwaukee, Des Moines, Indianapolis, they all process checks. But people don't write that many checks anymore. The peak of check writing was in like 2004, 2005. And the Federal Reserve made about 75 cents a check written. And that financed most of the Federal Reserve's operations. Today, I don't know how many cities are on here listed, but I don't know, there's going to be like, what, 20, 30, 40 cities in here where they were processing checks. Today, in the United States, there's only one city that processes checks, and that's Atlanta, Georgia. All checks are scanned, delivered electronically to Atlanta, and Atlanta processes all those checks. So let's look at what else the Federal Reserve does. The Federal Reserve regulates the banks. As it regulates the banks, it ensures that the banking system remains healthy. As a healthy system, we basically mean that it doesn't fluctuate that much. During the pandemic, one of the key roles of the Federal Reserve has been that it's a lender of last resort, meaning it lends when no one else will. That was also important during the 2008-2009 crisis as well. It does monitor conditions, financial conditions of banks. it's also the bank for banks. When I was with the Federal Reserve, I was with them um, sometimes in their research division, but also we would go into a bank as a regulator and ensure that they were meeting the conditions that they were subject to. For instance, that they weren't lending out too much money, that they knew who their depositors were, that kind of thing. But by far, the most important thing the Federal Reserve does is it controls the money supply. Controlling the money supply is in the hands, basically, of a non-governmental organization. The Federal Reserve is not part of the federal government. The Federal Reserve is again owned by the banks that are in that district. They're the ones that are the shareholders. The reason why that's so important, that the central bank is independent, is it ensures that the bank is done. The bank is controlling the money supply in the best interest of the economy, not so that someone gets reelected. Because if the Federal Reserve was controlled by the president, then presidents, when they're up for reelection, would like print a whole bunch of cash. And they would do that because they want to get reelected. Because if you print a lot of cash, at least in the beginning, what'll happen is, at least in the beginning, what will happen is that the economy will grow. By controlling the money supply, the other way to read controlling the money supply would be monetary policy, the setting of the money supply. The part of the Federal Reserve that controls the money supply is the FOMC, the Federal Open Market Committee. This is the part of the Federal Reserve when they say the Federal Reserve changed interest rates today. What they're really referring to is the FOMC. The FOMC is all the members of the boards of governors, 5 of the members on a rotating basis of the 12 regional banks. But of those 5, it's always New York. So the New York district's always represented, and then the other 4 are on a rotating basis, where they get a vote. They meet every 6 weeks. And what they do is they discuss how is the economy doing right now in those individual regions. And as a result, do we need to do anything? Do we need to change the money supply to alter the economic conditions? This is sometimes referred to as the Beige Book. Primarily because of the color of the thing. The Beige Book, what it does is it basically, well, let's look at what it does here. I don't need to talk about it theoretically. So when I was at the Federal Reserve, one of my jobs as well was working to create the District 7, the Chicago district, helping the economists write up the Beige Book sections. And let's just look at the most recent one here. Let's look at the one for Hawaii. We're part of District 12. Now, what it does is it basically takes anecdotes. By that I mean, let's just try to find one here. Look at this. So I'll kind of scroll it up to the top here. A contact in Southern California noted that thrift and secondhand stores experienced a rise in demand. Auto sales have continued to increase. So basically, they're just saying, "Hey, so and so from the Goodwill just told me a whole bunch of people are buying old dishware." Um, and so they use that information then to um, try to capture from these anecdotes some vision about what they think is happening in the economy. And what the FOMC does by looking at the beige book and considering all this information, it makes a decision not to actually print or take out of circulation money, because it can't just do that. Rather, what it does is it buys or sells existing US government bonds. In fact, the Federal Reserve is the largest holder of US government debt. It buys and sells the debt. To increase the money supply, it would purchase bonds from individuals. So if I owned US government treasury and I wanted to sell it, I could sell it to the Federal Reserve. And the Federal Reserve would pay me with absolutely new cash. And I would then put that money in my bank account. On the other hand, the Federal Reserve could make a sale. And if it sells it to me, I would pay it and it would destroy the cash I paid it, thus reducing the money supply. But besides the money supply being determined by how much cash there is, it's also determined by how banks behave. Banks also influence how much money is out there. That's a dumb joke. They can also change how much money is out there by making lending decisions. So banks in the United States do not hold all their reserves. In fact, we have what's called a fractional reserve banking system. Banks are usually only required to hold 5 to 6% of their deposits. They lend out the rest. That's how they make money. They make money by making loans and capturing a higher interest rate for the loans made versus what they have to pay in interest to the saver. So banks here on the islands like Central Pacific Bank, American Savings Bank, they finance 100% of the loans they make with deposits. So that's an easy way for them to make money because, as most of you know, savings accounts from like Central Pacific pay like point, 0.01% interest. But if a house mortgage costs 3% in interest, well, then the bank's going to probably make some money. So the banking system in the United States is a fractional reserve banking system. If it wasn't, and we had 100% reserve banking, then it would simply look like this. The bank would be here, and in the T account, in the balance sheet, you would have reserves of the amount, and deposits are a liability because the bank has to pay that out to the depositor if they ask for it. So the assets would equal the liabilities. But in a fractional reserve banking system, where again you have the reserve requirement set by the Federal Reserve, which again is about 5 to 6%, then if we have a 10% required reserve ratio, then it would be 10% of that $100 deposit. So $100 is deposited, multiply that by the required reserve ratio, and you will get the required reserves. Then they had $90 in excess reserves that could be lent out. And up until the financial crisis, banks lent out almost all of their excess reserves. Let's look at this. Now the data set stopped back in September. They didn't stop collecting the data, it's just represented somewhere else. But let's just look at it through September. Look at that. Up until the 2008-2009 crisis, banks had no excess reserves, meaning they lent out all that they were legally allowed to. And since the 2008-2009 crisis, they've stored a lot of extra money. And it only increased during the pandemic to new highs. That becomes concerning because what that means is that the Federal Reserve now has to print much more cash to be able to change the money supply. So I'm not even really sure how much of this I want to cover because this part's not as true as even when the textbook was written. Excess reserves dominate now the landscape. But let's just continue with this. Banks do just hold a fraction of their deposits. They do lend out something, but they certainly hold some extra money too. Thus, the banks are creating money when they lend it out. Right? Let's just look at it this way. Let's say that the Federal Reserve, the Fed, makes a $100 purchase of a bond from me, Shining. It gives me $100. I give the Federal Reserve my bond. I am going to deposit my $100 at my bank at Navy Federal. A sailor borrows the sailor then goes into their Navy Federal branch office and they get a loan for $90 to buy some clothes. The question would be is, what's the size of the money supply? The size of the money supply is now $190 at this point. It's my $100 in my account, and it's $90 in the account of the sailor when they first get their loan. Then, right, that's sailor like number one, because now we could have sailor number two. Borrowing 90% of $90, which would be $81, which would mean now the money supply is equal to the $100 plus $90 plus $81. And this would continue on and on until there's no more money to be lent out. That thing That process is called the money multiplier. After the $81, then it would be 90% of that, which would then be $72.90. Then it'd be 10% of that, right? So it'd be $7.29 subtracted from that, and so on and so forth. The multiplier, you don't have to do all these steps. The multiplier is going to be 1 over the required reserve ratio. In this case, if it was 10%, then it'd be 1 over 0.1, which is equal to 10. That $100 times 1 over the required reserve ratio would mean that for the Federal Reserve printing $100 or authorizing the creation of 100 new dollars, the banking system created $900 just by lending money to create that total of $1,000. So what that does is it also then highlights why it's a little bit concerning that banks are not lending out as much as they used to, because now that means that we're not going to get $1,000 out of making $100. We're going to get something less than that. And I just basically said this here. The only addition I could make here is that the smaller money multiplier comes from a higher required reserve ratio, which the Federal Reserve does set. So the Federal Reserve does set the reserve ratio, which would then mean it could change the money multiplier. Then when we look at the 2008-2009 crisis, we see here that the problems that banks had was in the valuation of the capital. And that the problem for banks was that they lent out too much money. They were over leveraged. And when a bank becomes over leveraged, depositors start to get concerned that they're not going to get all their money back. And I'm not going into too much detail here because what's more important is the other stuff, not just what the 2008-2009 crisis was all about. If you're interested in that, you should take the financial crisis class with me. I usually offer it every other year. If we look at the 2008-2009 crisis, the issue there was that banks were over leveraged to a huge extent. And so when those assets then became revalued, basically lowered in value, the banks found themselves unable to cover what was borrowed anymore because they were over leveraged. And that's what you see right here. If the assets are then reduced in value by 5%, then the leverage amount grows, which makes it harder then for the bank to pay that money back. I'm not going to keep going on with this. So what banks then were forced to do is they had to start calling in loans. They had to deleverage what they all had out there. They had to reduce their loans. And when you start to do that, when you start to remove credit from the economy, that reduces right? It would stop Scheiding from buying a house. It would stop you from buying a car. It would stop people from going to college, borrowing money to go to college. It would stop restaurants from expanding. All the things. The economy basically slows down when lending slows down. And the only way then you can fix this is by putting money back into the banking system, and specifically just giving money to the banks with the hope that they will lend it out. It turns out that banks did not lend it out. They were given huge chunks of money, $785 million to be exact. No, billion, $785 billion to lend out. And they didn't do it. They just held on to the money, as we saw here with the excess reserves having grown. Yes, all of us taxpayers did personally own the banks. We basically bought into the largest banks. We called these banks too big to fail, which is actually the title of a very good book by Aaron Ross Sorkin, as a description of what the 2008-2009 crisis was all about. So if we look at what the Federal Reserve has in its control, again, it can change the amount of money out there by both changing how much the Federal Reserve will lend to banks, also by the open market operations, the buying and selling of existing debt, but that it also changes the reserve ratio and how much excess reserves banks choose to hold. The tool used most often is the open market operation by far. As you see here, things can be decided every 6 weeks and sooner if needed, as was done last March during the pandemic. The Federal Reserve can instantly intervene and buy or sell existing US government debts. And again, by buying debt, they are increasing the money supply. By selling debt, they are reducing the money supply. And this is by far the tool most often used by the Federal Reserve. The Federal Reserve can lend to other banks through what's called the discount window, and the interest rate paid to borrow money from the Federal Reserve is called the discount rate. But most of the time, banks don't like to borrow from the Federal Reserve if they don't have to, because if you're the idea is that if you're borrowing from the Federal Reserve, something must be going on at your bank that you might need to be scrutinized a little bit closer. Again, this would be the interest rate that a bank pays the Fed for that loan would be called the discount rate. When the Federal Reserve makes a loan, it's making new money. So that would be another way that the Federal Reserve can change the money supply, is by making, in this case, more loans at the discount window. And it can make more loans at the discount window by lowering the interest rate, smaller discount rate. We have other things too. We have the term auction facilities, TAF, where the bank would decide how much funds it was going to lend. We don't need to worry that much about this. The reserve requirements are not changed very much. And it's primarily because it's difficult then for a bank to do its job of making 30-year loans, 10-year loans, if the Federal Reserve is just going to go in and change the reserve requirements. So this is not used very often. But if it were used for the reserve requirements, increasing the reserve requirements would decrease the money supply. And decreasing the reserve requirements would increase the money supply. But as we just saw, it's also not that effective because banks are holding excess reserves. Since the 2008-2009 crisis, the Federal Reserve has been paying interest on reserves. That interest it's paying, it's making that money to pay that interest. So the higher the interest rate, then the more reserves that banks will hold. And what that does is it actually reduces the money supply because banks then will make fewer loans. Now, in general, the biggest problem with what the Federal Reserve has when it's controlling the money supply is that it's not precise and it doesn't happen very quickly. And it can't control every aspect of the bank lending process. Okay. Yeah, I guess we can. I'll talk about this very briefly. I don't usually talk about the case studies, as you know, but you know how we always, well, when you see a bank advertisement, it'll typically say member FDIC. The idea here is that in the United States here, bank deposits are insured for the first $250,000 in deposits. So even if your bank failed, you'll still get your money back up to $250,000. And what it's designed to do is it's designed to allow banks to continue their fractional reserve lending practices. But it also creates trust. We trust that the fractional reserve banking system will not basically hurt us because we know we can always get our money back from the FDIC if the bank were to fail. If we didn't have the FDIC, then we would have run on the banks. The simplest way to describe that would be is I could spread a rumor that Banco is going to run out of money, and then all the depositors at Banco would run to the bank to get their money out. And in so doing would actually cause the crisis. Thus causing the bank to close its doors. This is the scene in It's a Wonderful Life. It's that really old Christmas movie. Well, that was a run on the bank. Oh, actually, we could try to see if there's a YouTube clip for it. Well, I'm not gonna watch 7 minutes of something. Ooh, let's watch it in color at least.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
So all these people here are that guy there in the cab. Oh, let's turn on the caption so you can see. That's the guy who's running the bank. And all those people are running to get their money out of the bank. And they're scared because they're all spreading rumor. The bank's going to fail. The bank's going to fail. And you scare them more because the bank is locked up. And there's all the depositors wanting their money back. Okay, so let's...
Hello, everybody. Miss Thompson, how are you? Arlene, what's the matter here? Can't you get in? Just took over the bank. I may lose a... George.
Let's see here. Oh, here they are. That's right. So there's all the people. They all want their money.
Now, look, why don't you all sit down? Here, there are a lot of seats over there.
Let's see here. But he makes a really impassioned and correct speech.
Payments to the bank. The bank's going to reopen next week.
But George, I got my money.
Cash payments to the bank. The bank's going to reopen.
Just read the lines here.
George, I got my money here. Did he guarantee this place?
Well, no, Charlie. I didn't even ask him. We don't need Potter over here.
And I'll take mine now.
No, but you're.
So all these people want their money back.
Thinking of this place all wrong, as if I had the money back in a safe.
He doesn't have it in the safe.
Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100.
So there, the guy's basically saying, listen, we don't have your money sitting in the vault. It's in that person's house, and that person's house, and that person's house.
You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do? Foreclose on them?
I got $242 in here, and $242 isn't going to break anybody.
Okay, Tom.
Now, there's a really funny scene here. I wouldn't normally
That's what you agreed to when you bought your shares, Tom.
The Simpsons.
No.
It's really funny because sorry, I wouldn't normally refer to something so old because some of you would say like, dude, Chetty, no one watches The Simpsons anymore or whatever. I just think it's really funny here, this one. Okay, look at that. So now, in this case, Bart Simpson, in case you've never watched the show, Bart Simpson would be the child of The Simpsons. Bart Simpson in this scene is going to start a bank run.
Mean the bank is out of money. Insolvent? You only have enough cash for the next 3 customers. Hey, what's
Look at that, he caused the bank run.
Wait, just a second here. No, I don't have your money here. It's in Bill's house and Fred's house.
Hey, what the hell you doing with my money in your house, Fred?
Hilarious. And Bert thought it was funny too. Okay. That actually ends this lecture. A pretty long lecture, but also pretty important.